You have probably seen headlines like this. Energy company A buys company B in a $10 billion deal. But here's the crazy part. A lot of that money isn't for buildings or machines. It's for oil and gas that are still underground, thousands of feet below the surface. So how do they know what that hidden oil is worth? Well, there's actually a calculation that answers that question, and it's one of the most important metrics in the oil and gas industry. It's called PV10. In this video, I will walk you through why PV10 exists, what it is, and how it is calculated, why it matters, and what its limits are. Before we talk about what PV10 is, let's talk about why it even exists. Figuring out what an oil and gas company is really worth is tough. If you look at a manufacturing company, you can see the factory, the machines, and the inventory. But in oil and gas, most of the value is hidden underground. The company believes there's oil down there, but nobody truly knows how much, how hard it will be to get, or what the price of oil will be when they sell it. That's a big problem for investors. You cannot see the real assets, and every company uses their own assumptions and methods to guess the value. It's like trying to compare two mystery boxes. You know they both have something inside, but you don't know how much or what it's worth. So, for decades, it was nearly impossible to compare energy companies on the same scale. And that's exactly why PV10 was created, to give everyone a common yardstick for measuring what's really underground. So how did the industry try to fix this problem? They came up with a standard calculation called PV10, short for present value of future revenues discounted at 10%. Okay, that sounds complicated. So let's break it down simply. PV10 is basically a way to put a dollar value on the oil and gas that are still underground. Using the same rules for every company, it helps investors compare different companies on the same scale. Instead of everyone using their own math, think of it like this. Imagine an oil field as a huge orchard full of orange trees. The oranges are the oil reserves. The juice you sell is the revenue. The cost to pick and squeeze the oranges is your expense. And since money you earn later is worth less than the money you earn today because of inflation and opportunity costs, you apply a discount. That's the 10% in PV10. PV10 is like adding up all the future profits from these oranges, adjusted for time, to find out what the orchard is worth today. That's what makes PV10 so useful. It gives investors a single consistent way to value what's underground. Now that we know what PV10 is, let's break it down into 4 simple parts. Every PV10 calculation uses the same 4 ingredients: proved reserves, future revenues, direct expenses, and the 10% discount rate. Let's go through each one step by step. First is the proved reserves. These are the barrels of oil or cubic feet of gas the company is pretty sure it can actually produce, not guesses or hopes. In the industry, reserves are split into 3 groups: proved, probable, and possible. PV10 only uses proved reserves to keep things realistic and conservative. Second is the future revenues. To figure out future revenue, the company estimates how much oil or gas it will produce each year and multiplies it by a price. But they cannot just guess any price they want. The SEC sets strict rules. Every company has to use the average oil and gas price from the past 12 months. That way, everyone's using the same reference price, not overly optimistic forecasts. Third are the direct expenses. Of course, producing oil isn't free. PV10 subtracts the future direct costs of getting that oil out of the ground, things like operating expenses, production taxes, and development costs. It does leave out corporate costs like executive pay, debt interest, and income taxes. And this is why PV10 is a pre-tax measure. And the fourth is the 10% discount rate. This is what adjusts future money to what it's worth today. Money you will get years from now, it's worth less than money you have right now because of inflation and opportunity costs. This is why PV10 take each year's cash flow and discounts it by 10% per year. That 10% is fixed. It doesn't matter how safe or risky the project is, so every company is on the same page. So when you add it all up, proved reserves, future revenue, minus direct expenses, discounted at 10%, you get the PV10 value. It's a simple formula, but it gives investors a consistent way to compare companies and see who's really creating value. Now, let's see how PV10 actually works in real life. We will use a simple example with made-up numbers, no spreadsheets needed. Imagine a company called Texas Standard Oil. They have a new well with 1 million barrels of proved oil reserves. Engineers estimate they can produce 100,000 barrels per year for 10 years. Now, let's figure out the money side. The SEC says they have to use last year's average oil price, let's say $70 per barrel. So 100,000 barrels multiplied by 70 is $7 million in annual revenue. Of course, pumping oil isn't free, so let's figure out the cost. Let's assume it costs $20 per barrel to operate and pay taxes. That's $2 million per year in expenses. So $7 million in revenue and $2 million in costs, that will bring in $5 million net cash flow per year. Now, let's move on to the discount. The $5 million you will make next year isn't worth $5 million today. When you discount it by 10%, it's worth about $4.55 million today. The $5 million from year 2 is worth a little less, around $4.13 million. If you keep doing that for all 10 years and add up all those discounted amounts, you get a total of about $30.7 million. When you sum it up, that $30.7 million is the PV10 value for this well. Every oil company does this for all of the approved oil and gas fields and adds them up. That total PV10 number is what you see in their annual reports. Now, we have done the math. Let's talk about why PV10 actually matters and what its limitations are. So, why does it matter? PV10 gives investors a common yardstick for comparing oil and gas companies because every company has to follow the same rules. Use only proved reserves, use the SEC's average oil prices, and applies the same 10% discount rate. It levels the playing field. That means you can finally compare companies like Occidental, EOG, and Diamondback side by side using one consistent measure of what their proved reserves are worth. So how does investors use it? Investors often compare a company's PV10 to its enterprise value. Basically, the total value of the company, including its debt. If PV10 is much higher than the enterprise value, it could mean the stock is undervalued. You're getting more oil in the ground than what the market is pricing in. So what is its limitation? PV10 has its limits, and it's important to know them. First, it ignores probable and possible reserves. That means if a company has big exploration upside, PV10 does not count that. Second, it uses historical prices, not current ones. So if oil jumps to $90 today, PV10 still uses last year's average, which could make the company look undervalued or overvalued depending on the timing. Third, the 10% discount rate is fixed. Even though risk varies, a project in West Texas and a project in Africa gets the same rate, even though one is clearly riskier. And finally, PV10 is pre-tax. It doesn't include corporate overhead, interest, or taxes. So the company's real cash flow will always be lower. Here's the bottom line. PV10 is great for comparing companies on equal terms, but it's not a crystal ball. It gives you a baseline, a place to start, but not the full picture. Smart investors use PV10 as the foundation, then dig deeper to adjust for risks, taxes, and real-time oil prices. To wrap it up, PV10 is the industry's way of putting a dollar value on oil and gas that's still underground. It takes all the expected future cash flows from proved reserves and discounts them back to today at a 10% rate. It's not perfect. It ignores taxes, probable reserves, and current oil prices, but it gives investors a consistent starting point to compare companies on equal terms. When you're analyzing oil and gas stocks, PV10 helps you separate what's hype from what's actually there. It's the baseline that cuts through the noises. So, what do you think about PV10? Have you ever looked at it when researching an energy stock? Drop your thoughts or question in the comments. I would love to hear them. If you found this video helpful, please like it. It will really help the community grow. And don't forget to subscribe so you don't miss future deep dives on metrics like lease operating expenses and more. Thanks for watching. I'll see you in the next one.